Hello, welcome to Shrink Rep. My name is Edna Lazat. I'm a clinical social worker, and my co-host here is Szifra Birke. And Szifra is an executive or business coach. Okay. Today we are happy to have someone very lovely with us. We usually don't pick people by the way they look, but Brenda looks gorgeous.
Thank you.
Brenda Wenning is the founder of Wenning Investments, and your firm is based in Newton, and you have 24 years experience as a financial advisor.
That's right.
You don't look that old. Sorry. Anyway.
Oh, thank you.
And you advise to individuals and businesses.
That's right.
Okay. What we're going to talk about today is, what do you mean by investment psychology?
Well, investment psychology plays a very important role in the money management business. And as an investment advisor, I've been doing this 24 years, and I would say the most difficult challenge for the investment advisor is definitely managing the emotions of clients.
Oh. So it's not the ups and downs of the Dow or NASDAQ, it's the...
No, it's really the investors, their psychological makeup, how they feel about money, because if the advisor has the right risk management tools in place, they're not going to have to worry about the ups and downs of the market, because you can control a large part of that and make a client comfortable. But it's the client's emotions that are really difficult to control.
And you call it risk management?
Right.
Explain that to me. What does that term mean?
So risk management, let me kind of step back. When I first started in this business, I started on the buy and hold side. So that's kind of, with a philosophy of buying a lot of securities and you hold them for a long time period, and the markets can do this, a lot of up and down, but you just kind of, go with the flow, keep those investments, and you may shift things around a little bit. But when you are an active manager, such as myself, and you incorporate risk management tools into your strategies, you're trying to kind of smooth out this part of the market, and you're looking for returns that are a lot more consistent.
Okay.
And if you go back to the technology crisis when in 2000 and 2002, a lot of investors lost a lot of money. And I was managing money at that time, and I saw a lot of investors where they kind of got into like this herd mentality of, everybody is buying technology. I have to own technology. And as an advisor, you would say to your client, there's such a thing as asset allocation, and we can't have your whole portfolio in technology. But a lot of clients wanted to be there because that's where all the money was being made.
Right.
So those emotions were really driving their investment decision making. And as the advisor, it's your job to kind of stop and say, wait a minute, is this really what we want to do? And if we do this, these are the risks that are involved. And it's, it's one of those things. You don't want to have all your eggs in one basket, because eventually things may not go right.
Okay. So if I wanted to invest in something like Cha-Cha teddy bears and you didn't think it was a good idea, you'd have to talk me out of it.
I would have to talk you out of it.
Okay. What if I wouldn't let you?
Then I would probably go along with it and say, let's just use a little bit of maybe some of your fund money, a small piece of the asset allocation, maybe 2% of the portfolio or 1%, and let you have that, your decision making was a large part of making that buy decision.
How do you determine what kind of person I am about money?
Well, when you step into a financial advisor's office, there are a lot of questionnaires that we go through, and also a lot of questions that we're asking the actual individual on how they feel about money. It could be things like, how often are you watching CNBC, or do you watch Fast Money? Are you reading the financial journals? Or, are you a day trader? How do you feel about losses? What's your time horizon for this money? Are you a person who gets really excited about the market when the market's going up, or you never look at it and have no idea what's going on? So there's a lot of questions that need to be asked to try to figure out the mindset that makes up the individual.
You have a lot of power.
Yeah, we do. As a financial
you have a lot
advisor.
of power for people who don't know anything about the market, or people really have to trust you.
That's right.
And yeah, money's an important issue. So.
Right, and it's so emotional.
Yes.
It's just so emotional.
Yes.
And, you know, my experience, I mean, Brenda and I know each other because I work coaching wealth managers and financial planners, and so, you know, we're in some of the same circles. And it has been really interesting for me as a coach to realize just what you're saying, how much power, and how do you help an advisor really understand us, as well as understand the psychology when things are, like right now, I'm in a very low risk portfolio, relatively speaking. And so some part of me wants to jump in because the stock market is going, you know, up.
Right.
And so before the show, we were talking about Edna being invested in, you know, a much more aggressive kind of, you know, a more risky, high risk portfolio, and I am, you know, working to preserve what I've earned and am willing to not gain in order not to lose. So when you think about just any aspect, Brenda, of the two of us, if we were your clients, how do you talk about what you do in light of like our age or boomers or?
Yeah, that's a great question. I think that it definitely comes down to each individual client's investment objective. So if you have a conservative investment objective, then the portfolio is going to be constructed in a much more conservative way. On the other hand, you know, I would have a lot of questions for you to see how you actually feel about money. And, you know, if you went through the technology bubble, if you went through the financial crisis in 2008, you know, how were you feeling then? Did you lose a lot of money? And if so, how did you feel at the time? Was it something that you felt, I never want to do this again? Is there a way to prevent it? And I would say, yes, there are ways to prevent that. I mean, there are risk measurement techniques and strategies that you can use to avoid some of that. But it all comes down to your emotional makeup, because you could be a very laid-back person, have no concern about money whatsoever, and you know, you like living kind of on the edge, and you know, let the markets do this, and you know, you get a rush by that. I mean, some people do.
Yes, some people do.
Psychologically and emotionally, I've lived enough life to know that things never go in a straight line. That there are ups and downs and ups and downs, and that the stock market is no different than that. It will go up, it will go down, it will go up, and it will go down, and it will go down, and it will come up again. And you know, the thing is, can I hang in there long enough to watch it come back? And when was the last dip? Really, 2007 was when we really lost a lot of.
2009.
2009
was the worst.
Okay, and it's moving up now. Now it's not going straight up, but it will recover. Maybe it'll never be the same as it was before, but I know that things go
ebb and flow.
Yeah,
they ebb and they flow.
Yeah.
So you just don't worry too much. You think?
Well, I don't. I mean, I when I hear horror stories about the depression and when people lost everything back in the 30s, was it? I don't feel that way. Yeah. I don't feel that I should jump off a building because of the money.
Right.
But I think that you have to be realistic enough. I'm either going to put that money in my mattress
and lose money.
Yeah.
Right? Yeah.
Or I'm going to trust someone to do a good job and to kind of hold me and emotionally and say, okay, Edna, it will come back again, and you know.
So that person that you have may have more of that, what you called initially, that buy and hold strategy,
yes.
right?
Yes.
That may be
yes.
who your person is,
yes.
and that's worked fine for you.
Yes.
And for some of us, we've made a decision to go a little different direction, and it's interesting to know, I bet most of our audience doesn't know that there are different kinds of financial advisors. Like when you mentioned active, my guess is people don't know. Does that mean you get on the treadmill every morning?
Yeah.
Or, you know,
I wish. You know.
You know, what does being active mean versus the more traditional kind of buy and hold? Can you say something about that?
Sure. So active management it's a very broad statement, and for me, what it means is I'm active to the extent that when portfolios and markets start declining all at the same time, it's time to take notice. It's time to take my losses or to take profits. So it's really about raising cash at different levels in the market so that I can protect portfolios, because clients that go through 20% drawdowns or 20% declines in their portfolio, it is really difficult to make back that money. And if you think about what happened in the technology bubble, some people lost 50% of their money. When you're starting off with now a 50% loss, you need 100% return to get back to where you were previously. Right. So active management is about using tools on how to avoid having those steep losses in portfolios.
Got it.
And it's not a perfect science. It's, I use a lot of the fundamental strategies that I used from my previous background of the buy and hold. So I kind of combine the two together. But I think that it gives the clients a nice safeguard feeling that I can go to bed at night and not have to worry about this, because what happened to me in the last two markets, I can't have that happen to me again. I have clients that are like that.
Especially in a certain time horizon.
Yeah.
I think it depends on how long we think we're going to live, maybe, and how long we feel like when we're going to start to want to draw down some of that money.
Right.
I mean, all those things that make a difference, right?
And realistically, what are you saving the money for? I have friends that I know that are saving the money so that they can give it to their children. I'm not saving, my family will never get a huge inheritance. I'm saving it so that I can travel all over the world. But realistically, by the time you're a certain age, you can't do that. I'm
Right.
saving, you physically, you just can't do that.
Right.
You don't have enough stamina.
So I think that's a really good point, Edna, that some of us are really both conservative in the way we invest and conservative about like worrying in a way that you don't.
No.
Like, what are you saving for? Like, if somebody asked me that question, I might say, well, I have this idea that I'm going to live into my 90s, and I want to have enough money at that point not to do things like travel or buy extravagant things, but for medical care and for, I'm going to probably need, like what my mom needed was some outside assistance, and I would like to be able to pay for that so that I'm not beholden to, a system that won't provide as much for me. So
I never think about that.
no, and some
Yeah.
people don't, right?
Yeah, and that's okay. I mean,
Right.
but as I'm sure that you've had conversations with your advisor about what your investment objectives are, and your advisor is well aware of them.
Right.
And you have a plan in place, and that's really what
Yeah.
it's about. And maybe you don't live within a budget. Most of my clients, I try to keep them to live within a budget.
Right.
And I have some that are overspenders, and they keep coming back to me for more and more money. And I look at their portfolios and I'm saying to myself, they're going to be out of money in 10 years if they continue to spend at the rate that they're spending, because we're in a much slower economic environment. So you kind of have to tailor portfolios to the client's lifestyle. You have to, tailor it to some of it's tailored to their emotions, and also to, a benchmark of a number that they're looking for.
Yeah.
Okay, if she wants to live to be 90, how much money how do you figure out how much money she'll need to do what she wants to do?
Well, you have to look at how much money they have today,
Yeah.
how much debt someone has, and
Yeah.
then where they are in that cycle. Is their debt paid off? Are they still accumulating debt? And then you put a plan in place. Usually you start with a budget, and you're trying to look to see where some of the expenses are that maybe we could cut back on. And maybe it's not taking 2 extravagant trips a year. Maybe it's only taking 1, or maybe you don't take any at all. And from there, you are designing a portfolio based on if you can reach, maybe it's a 3-4% return that client needs to get them to where, to the end result. So at that point, you don't need to take on a lot more risk in order to get the client to that end result.
Okay.
So
What's a good percentage? If I call you on the phone and I say, Brenda, what percentage is my money earning? Or you call me and say, don't worry, Edna, your portfolio is earning 3%. And I say, woo, yippee. Is that good or bad?
Well, so it's benchmarked to something. So if your portfolio is a conservative portfolio and you're invested in short-term bonds, then that would be a very good return for a short-term bond portfolio. And
Because it's low risk.
Because it's low risk, exactly. And if you are someone who's invested in 100% stocks, then you should be right up there where the market is. And so if the market's returning, 18% for the year, then you should have a return that's in line with that.
Right. Okay.
So, Brenda, we were all talking before the show about emotional situations that come up for clients.
Yeah.
Like they've inherited a stock and then they don't want to sell that stock because their dad owned it. Or
Right.
can you talk about some of the kinds of, you can camouflage the clients, but can you talk about some of the situations you bump into?
I see that a lot, and clients often become, especially some of the widows where I manage money for them, they often become very emotionally attached to their spouses, the stock of the company that they worked for, and they have a really difficult time letting go. And I had one particular client that would not let go, and she didn't want to sell any of it. And then we went through the 2008 financial crisis, and at that point, her whole lifestyle changed because she was adamant about not selling the stock, not diversifying the portfolio. And at that point, as an advisor, you almost say to them, "What do you need me for? Because I'm not really managing the portfolio. You're really controlling this right now." And if your wishes are to stay 100% in, or 80% of your allocation to your ex-husband, not ex-husband, but your deceased husband's company stock, then you're putting your lifestyle in jeopardy, and you may not have enough money. It may work out, but what if it doesn't? And I've seen those situations where it doesn't work out, and where it ended up being a really bad decision because the company ended up, during the financial crisis, the company ended up cutting their dividends. The stock, went down probably 70%, and it was,
And was she living off of that income?
She was living off of the money.
And that's the whole piece back to when we were talking about the time horizon. It's one thing if you have 40 years, no problem to do that up and down. If though the junky time in the market comes right when you start to think, well, this is when I'm going to start to live off of my income, and your income goes from whatever to half of whatever. If you were able to get $50,000 a year and suddenly it's $25,000 plus Social Security, your lifestyle's really different. Or you have to withdraw more of your principal, so you're not going to have it very long. So those are the kinds of things that I think about.
It's different now also because people don't get pensions. Most people
Right.
don't get pensions. People could count on Social Security and a pension, and that doesn't happen. I have something I just thought about. You're talking about our emotions. What about your emotions?
Often I have to sit on my hands.
Okay, because you have things that trigger certain responses.
Yeah, if I have a client who is peppering me with emails every single day, that person is now in my head. And so the decisions that I'm trying to make and trying to stay on track with that client's investment goals, if I'm getting an email every single day to do something or not to do something, I'm not going to push that button because I know that it's going to spark an email if I do
So
something.
you're not going to push that button means that you're not talking about push, send, or not send. You're not going to buy or sell
a security.
something that you think should be bought or should
Right.
be sold because
Yeah.
you're suddenly going to be deluged again with why did you do that? Why
Right,
didn't you do that?
exactly.
So it ties up your hands
It does.
to do the thing that you think would be most right for that client when they're
does.
too involved.
And
That's what
part
you're
of-
saying?
Yeah, it is. And it's part of, as a financial advisor, it's really important to kind of vet the client out to make sure that the client is somewhat consistent with how you manage money. And, I'm getting much better at it than when I first entered the business. I would take clients and, it seemed like anyone seemed, if they had money, I would take them. And then I learned, some valuable lessons, that there were some people that were considered hot money. They were looking for day trading, and I'm like, I'm not a day trader. Just because it says active doesn't mean I'm day trading. That's not what I'm doing.
Right.
So it's interesting, Brenda, what you're saying is that it's not only the client who's choosing the advisor, but in the ideal world, the advisor is also choosing the right client for the way
Right.
that they manage money.
That's right.
Yeah.
That's very important. And I think that, there are some that are still, kind of in that methodology where they'll take anybody because they're, they're growing their practices or they're new to the business. But you find out, within a couple of years where you made your the bad decisions, and where you went wrong, and then you learn from it, and those are great learning experiences too, by the way.
Yeah, so I was thinking about other kinds of emotions that I bump into as the coach, as an executive coach of people who are doing this, and that's one of them. Another is like when someone doesn't do what you think is best for them. So if maybe that's where that mismatch is. So that if you wanted Brenda to do cha-cha hula hoops or whatever you called it,
They went out of business.
right,
She wouldn't buy that.
It was
stuff.
Right.
good. It was only 1% of the portfolio.
right. But let's say that you wanted a higher risk portfolio than, or a lower one, because I've been in the spot where advisors of mine thought that I needed to push into something more risky. So it's really challenging for them.
Yes.
Very much like a psychotherapist.
Absolutely.
Right? Where you watch somebody doing what you think is the wrong thing,
Right,
and you
right.
really don't have control.
Right.
And what do you do as an
Or
advisor?
anything, like a physician.
Right.
You tell people what they should do, and
Right.
then you have your own. And is it wise? And this is a really generic question. For you to manage your own portfolio, or if I were a financial advisor, is it smarter to have me do it? And if I were a friend of yours, your own personal money.
Own personal money. I think that it depends upon your own makeup of.
Okay. The same thing.
Yeah.
Right.
I mean,
Right.
I had to go through a lot. I manage my own money personally. I trade in the futures market, which is a completely different animal than the
Right.
stock market, and you learn a lot about yourself
Yes.
when you do that,
Yes.
and how you feel about money, and you have moments where you have the biggest pit in your stomach. You feel like getting sick, and
Right.
So that swings me to answer a question, and then let's move it right back to you. But I was just thinking about that, just like the client, the advisor has a relationship with money, right?
Oh,
and is
absolutely.
That,
That's right.
Is that relationship with money based on status or security or being carefree and spontaneous or being what is that?
Right.
And that has to influence.
Absolutely.
And I think a lot of interestingly enough, a lot of financial advisors aren't necessarily aware of their own relationship with money.
Right.
Would you agree with that?
Yeah, I definitely would agree with that.
Which is kind of interesting. It's like, again, the therapist who doesn't know themselves, who's trying to help somebody else know themselves, right?
Yeah.
And
But I hope that you know your style by now, what you're more comfortable with.
Oh, absolutely, I
Right.
do.
Right. I think
do.
after doing it for a while, what you're really comfortable with. I think she should know that at the time.
Oh yeah, and I think that when you described, you learn a lot about yourself and money when you do your own investing. It sounds like you have learned a whole lot about your relationship with money.
Yeah, I mean, there are times where, not only, and this happens with clients as well, where the adrenaline kicks in and they're getting so excited and they want to run out and buy, it could be a car, it could
Right.
be, and their mind is made up that they're going to do that. And it may not be the best decision. They may be, maybe they're having layoffs at their firm, and maybe it could potentially happen to them, but they're not even thinking about that. It's, I'm in love with this car, I got to go and buy it. And
Right.
the adrenaline's kicked in, and there's nothing you can do at that point.
Right.
You bought the car.
The trains,
Right.
the trains, right,
trains left the
track,
station.
right, left the station.
So what do you want our audience to know that we haven't talked about?
I think that, some of the pitfalls of investor psychology is, a lot of those patterns will be repeated over and over again. I mean, it's, been well documented that it is. I think that one of the most important things is, really understanding how you feel about money, and those areas where when you really start to feel sick to your stomach over money, then you need to be talking to your advisor or talking to someone, because you shouldn't be feeling that way. And in a situation like that, in 2008 and 2009, when we went through the financial crisis and the subprime market, it really, a lot of clients, I think, were choosing to listen to, this is where you're looking for the confirmation bias of, I'm only going to listen to the positives in the market. And during the whole time of 2008, in 2007, I was basically out of the market by the end of the year. And so I didn't go through a lot of what people went through in 2008.
You're saying you and your clients?
My clients.
Uh-huh.
And I was also building my practice at that time. And you see that clients, even if money's coming in and they understand that we're in difficult times in the market, people started anchoring on to ideas in the market that they would hear something on CNBC and say, you know what, they said the financials have bottomed. It's time to buy the financials. Well, in the meantime, I have a lot of skills, a skill set that a lot of people don't have. And it's looking at a lot of charts and understanding the technical side of the market, which keeps me out of trouble. And by doing that, I think that, it gives the client that feeling of, I can go to sleep at night and not worry, because she's going to get me out. She may not get me out without any losses, but I'm not going to lose 40 or 50% of my money. And to me, that was one of the biggest learning experiences that I've been throughout my whole entire career, because I started on that side where it was buy and hold, and you go through, these horrible markets, and clients will tell you, oh, I can, 10% decline is not going to bother me. I have a high risk tolerance. You give them a 5% decline, they're on the phone with you immediately, calling you, what's going on, should we be selling? And you're like, whoa, wait a minute. I thought that you could withstand, but people really can't, because when they start losing money, that's when all the emotions really start coming out. Yeah.
So how do people get in touch with you?
Well, I have a website.
Okay.
It's winninginvestments.com, and I also have a blog, winningadvice.com. And I'm
And a
in
phone number?
Massachusetts.
You want to give a phone number?
Phone
right
number
now?
is area code 617-965-0680.
Do I have to have a big pile of money?
No, you don't have to have a big pile.
I don't have to have a big pile.
Medium-sized pile would be good, but
Medium-sized pile.
But it is true that that's a really good question,
it
because
is,
some
yeah.
advisors, if you don't have $2 million, then you can't see them.
$500,000 is typically my minimum. I've been known to go to $250,000, but I try to stick to $500,000.
Okay. And all I have to do is either probably call you and make an appointment.
Right.
Or email, I guess.
Or email.
Is it Brenda at Wenning Investments?
It is.
Uh-huh.
Okay, I can email you. Well, this information is on the screen, so the people will be able to see it. But it's always good to hear it. Well, do you have any words of wisdom? Because we're finished.
We're finished?
Yeah.
Well, I was just thinking that, people tend to do either one end or the other about money, right? They avoid looking at it, paying attention to it, so they never open their statements, or they're peppering you, to borrow your phrase, peppering you with emails and looking constantly. And I think the trick is, for most of us, how do we get a little bit more balanced about how we deal with our investments? So
Are you supposed to open them?
There you go.
I don't know. I write my grocery list on the back.
There you go, without opening them, right? Yeah. Well, it is a way. It's worked for you.
Well, that's what I do. I don't. Yeah.
Or she hasn't opened her statement.
Right.
Well, it doesn't change that much from one time to the other. So, and I don't understand half of it anyway. All these little numbers. But you're right. No, people have to. People, I don't think, are concerned about money until they think about retiring or not working, and then they say, oh wow.